Hey, welcome back. It's really good to have you here with us today. I'm Emma.
And I'm Nico. We're so happy you joined us for this one, because today's episode is one I genuinely wish I had when I first started learning about investing.
Here's something you've probably heard. Someone says, I invest in the S&P 500. Someone else says, I prefer ETFs. Another person says, I buy individual stocks. And you nod, but inside you're thinking, what does any of that actually mean?
I did that for a long time. I nodded, I smiled, and I had no idea what they were talking about.
And here's something important we want you to hear. You may feel dumb when it comes to investing, but you're not. No one actually taught you this, not in school, not at home. So today, we're going to break it down clearly and show you how to talk about it with confidence.
By the end of this episode, you'll understand three things. Number one, what an index is and why it matters. Number two, the difference between a stock, an ETF, and a mutual fund. And number three, what sectors are and how to talk about them like an educated adult.
This isn't about picking winning stocks. This is about understanding the big picture, how the market is organized. Once you see it clearly, everything makes more sense.
Before we start, we want to hear from you. In the comments, tell us, do you currently invest in anything? It could be a savings account, a retirement fund, anything at all. Write it in English. We want to see you practicing.
All right, let's get into it. So let's start with the most familiar concept, the stock.
Yes, most people have heard this word, but what does it actually mean to own a stock?
Here is the simple definition. A stock is ownership in one company. When you buy a stock, you become a part owner of that business.
So if I buy Apple stock, I own a small piece of Apple?
Yes, a very small piece, but you are an owner. And with that ownership, you get two things. First, a claim on profits. If the company makes money and decides to share it, you receive a portion. Second, voting rights. On certain important company decisions, you have the right to vote.
So it's not just a number going up or down on a screen, it's actual ownership.
Right, that's an important shift in thinking. Now, each company also has a ticker symbol, a short code used on the stock market. Apple is AAPL. Tesla is TSLA. McDonald's is MCD. These are the names you see in the financial news.
I always wondered what those letters meant. So AAPL just means Apple. It's that simple.
Exactly. It's like a nickname. Fast, simple, universal.
Now here's something important. When you own just one stock, one company, there is a specific risk that comes with that.
Yes, this is called company-specific risk. It means something goes wrong inside that one company. A bad product, a legal problem, a leadership failure, and your investment is directly affected.
So if I own only Tesla stock and Tesla has a bad year, I have a problem.
That's it. That's company-specific risk. You are concentrated in one place, meaning all your money is in one company. And that is an important reason why many people prefer not to put all their money in one stock.
Got it. So stock equals ownership in one company, claim on profits, voting rights, and company-specific risk. That's clear.
Perfect. Now here's the language you'll hear when people talk about stocks.
I own shares in Apple.
I invest in individual stocks.
That stock is volatile.
Volatile. Let's define that. Volatile means the price moves up and down quickly. A volatile stock can gain or lose a lot of value in a short time.
I'm building a position in Tesla.
Building a position. This means gradually buying more shares over time. It's a phrase you'll hear from people who talk seriously about investing. It sounds much more intentional than just buying shares.
And here's one more. I want to get exposure to the tech sector.
Exposure means you want your money invested in a certain area of the market. We'll come back to sectors in a moment, but first, let's talk about indexes. Okay, this is one of the most important concepts in this entire series, and also one of the most misunderstood.
Most people think the stock market is one thing, like one big number.
Right, but the market is actually made up of thousands of companies. So how do we measure it? How do we know if the market is doing well or poorly today?
That's where an index comes in.
Good question. An index is a group of stocks used to measure how a part of the market is performing.
So it's not something you buy?
Right, it's a measurement. It tells you how that group is doing overall.
Like a report card?
I love that. It's like a report card. It tracks how the group is performing.
So let's look at the four main ones.
There are 4 major indexes you'll hear about all the time. Let's go through each one simply.
Number 1, the S&P 500.
The S&P 500 tracks 500 large U.S. companies. It is the most widely used measurement of the American stock market. When someone says the market is up today, they usually mean the S&P 500 is up.
Number 2, the Nasdaq.
The Nasdaq is heavily focused on technology companies. Apple, Microsoft, Amazon, Google, these are all large parts of the Nasdaq. When tech does well, the Nasdaq tends to go up.
Number 3, the Dow Jones.
The Dow Jones, often just called the Dow, tracks 30 large, traditional American companies. It's one of the oldest indexes. Companies like Boeing, Goldman Sachs, Coca-Cola.
And number 4, the Russell 2000.
The Russell 2000 tracks 2,000 smaller American companies. These are called small-cap companies.
Let's define those words quickly. Large cap. What does cap mean here, Emma?
Cap is short for market capitalization, which just means the total value of a company. Large cap means a big, established company. Small cap means a smaller company, often newer or still growing.
So when someone says small cap stocks underperformed this year, that means the smaller companies did worse than expected?
Right. Underperform means to perform worse than expected, or worse than the market average. You might also hear overperform, which means to do better than expected.
And the S&P 500 is the benchmark?
Yes, the benchmark. This word is important. A benchmark is the standard you compare everything else to. When investors want to know if they're doing well, they often compare their results to the S&P 500. That's the benchmark.
Now here's something that surprised me when I learned it. You cannot directly buy an index.
This is a very common misunderstanding. When someone says, I invest in the S&P 500, they don't mean they literally bought the S&P 500. You can't. It's a measurement, not something you can purchase directly.
But you can buy a fund that tracks it.
And that brings us to ETFs and mutual funds. Okay, so now the question is, if I want to own the S&P 500, what do I actually buy?
This is where it becomes very clear. Let me use a simple picture. Imagine you're in a grocery store.
A stock is like a single piece of fruit, one apple. You choose it yourself. You carry it yourself.
An ETF or a mutual fund is like a prepackaged gift basket. It already contains many fruits, many companies, selected and packed for you. You just buy the basket.
And the index, like the S&P 500, is the shopping list that tells the basket what to include. You don't buy the list itself, you buy the basket that follows that list.
I love that. So the index is the list, the fund is the basket, the stock is one item.
Perfect. Now let's look at ETFs and mutual funds separately.
An ETF, Exchange Traded Fund. Simply put, an ETF is a basket of companies that you can buy and sell like a single stock.
So an S&P 500 ETF owns shares in all 500 companies inside one investment. When you buy one share of that ETF, you are instantly diversified.
Diversified. Let's define that. Diversified means your money is spread across many companies, not concentrated in just one.
The opposite of company-specific risk. Instead of betting on one company, you own a piece of many.
And ETFs have something called an expense ratio.
The expense ratio is the yearly fee the fund charges you to manage your money. It's expressed as a percentage. A good ETF might charge 0.03% per year. That's very low.
And why does the expense ratio matter?
Because fees eat into your returns. Even a small fee over many years can reduce how much your investment grows. That's why you'll hear investors say, I prefer low-cost index funds. They want to keep as much of their growth as possible.
So, it's eating into my returns. That's what a high expense ratio does.
Good. Now, mutual funds work very similarly. A mutual fund is also a basket of companies, and it's also professionally managed. But there are two key differences. First, mutual funds are usually traded only once per day, not throughout the day like ETFs. Second, mutual funds can sometimes have higher fees.
But the big idea is the same. Both allow you to own many companies at once without trying to pick winners yourself.
That's the key philosophy. Owning a fund, whether an ETF or a mutual fund, means owning the average performance of many companies instead of betting on one.
And for many people, that's a very calm, rational choice.
Now, let's try something. Nico, say a sentence you might hear from a colleague.
Sure, I'm mostly in index funds.
If someone says that, what do they mean? They mean they prefer broad, diversified exposure instead of picking individual stocks. They're not trying to beat the market. They're trying to match it and keep fees low.
And what if someone says, I like owning individual stocks?
That means they're comfortable with company-specific risk. They believe they can pick companies that will grow. They're more concentrated and more active.
Neither is wrong. They're just different philosophies.
And now you have the language for both.
Here's the key language from this section. Say these with us.
It tracks the S&P 500.
It's diversified.
It has a low expense ratio.
I prefer index funds.
I want to get exposure to the market.
I'm building a position slowly.
Practice those. They are the sentences of an educated adult investor.
Okay, now we go one level deeper. We've talked about individual stocks, indexes, and funds. But inside the market, inside those 500 S&P 500 companies, there's another way the market is organized.
The market is divided into industries called sectors. Think of it like a large shopping mall. The mall has many stores, but they're organized into sections: electronics, food, clothing, health, finance.
The stock market has the same idea. Let's go through the main sectors.
Technology. Companies that make software, hardware, or digital services. Apple, Microsoft, NVIDIA.
Energy. Companies involved in oil, gas, and energy production. Exxon, Chevron.
Healthcare. Drug companies, hospitals, medical devices. Johnson & Johnson, Pfizer.
Financials. Banks, insurance companies, investment firms. JP Morgan, Goldman Sachs.
Industrials. Companies that build things. Planes, machines, large structures like roads and bridges. Boeing. Caterpillar.
And then, consumer discretionary. This one needs a moment.
Discretionary means things people want, but don't absolutely need. If the economy is strong and people feel confident, they spend on discretionary items. If the economy is difficult, they cut back.
So McDonald's is consumer discretionary, not food, which is necessary?
That's right. McDonald's is a choice. Eating at home is cheaper. McDonald's is something people spend money on when they feel comfortable. That's discretionary. Nike, Amazon, Starbucks, all consumer discretionary.
That's a very interesting distinction.
Now, Here's how educated people talk about sectors.
I'm overweight in tech.
Overweight means you own more of one sector than the average investor does. It doesn't mean too much. It just means more than the market average.
Energy stocks performed well this year.
Tech stocks pushed the Nasdaq higher.
I'm diversified across sectors.
That last one is important. Diversified across sectors means your money isn't all in one industry. If technology falls, your healthcare or energy holdings might stay stable.
So it's not just about owning many companies. It's about owning companies from many different industries.
That's true diversification.
And one more phrase, very useful. I want to get exposure to the healthcare sector.
Exposure, remember, means you want your money invested in a certain area. You're not picking individual companies. You just want to participate in what that sector does.
That is very adult language.
It really is.
All right, let's talk about some common mistakes. These are things even smart people get confused about, and understanding them will make you sound more confident.
Mistake number 1, thinking the market is one thing.
Students often say, the market went up today. But which market? The S&P 500? The Nasdaq? The Russell 2000?
Incorrect. The market went up. Correct. The S&P 500 was up 1.2% today. Or, tech stocks pushed the Nasdaq higher. Be specific. It sounds much more intelligent.
Mistake number 2, thinking you can buy an index directly.
Incorrect. I bought the S&P 500. Correct. I bought an ETF that tracks the S&P 500. The index is a measurement. You buy the fund that follows it.
Mistake number 3, using the word stocks to mean everything.
This is very common. People say, I invest in stocks, but they might actually be in ETFs or mutual funds. These are different things.
Incorrect. I own stocks when you actually own an ETF. Correct. I own shares in a fund that tracks the S&P 500, or simply, I invest through index funds.
Mistake number 4. Thinking diversified means safe.
Diversified means spread. It means your money is across many companies or many sectors. It reduces risk, but it does not eliminate it.
Incorrect. I'm diversified, so I can't lose money. Correct. I'm diversified, so I'm not exposed to any single company's failure. The risk is smaller, but the market can still go down.
These 4 mistakes, if you avoid them, you'll already be ahead of most people in how you talk about investing.
Good. Now, let's practice. 6 situations. Choose A or B. Ready?
Let's go.
Situation 1. Your colleague says she owns 500 companies in one investment, and it costs almost nothing per year. Which term best describes her investment? A, an individual stock. B, a low-cost index ETF.
The answer is B, a basket of companies, tracking an index, with a low expense ratio. That's a low-cost index ETF.
Situation 2. Someone says, the market is up. Which response sounds more educated? A, oh great, so all stocks went up? B, which index are you referring to? The S&P 500 or the Nasdaq?
The answer is B. The market is not one thing. Asking which index shows you understand the structure.
Situation 3. A friend says, I'm overweight in tech. What does that mean? A, he thinks technology is too complicated. B, he owns more technology stocks than the average market allocation.
The answer is B. Overweight in a sector means more concentration there than the market average.
Situation 4. Which sentence uses the correct vocabulary? A, I bought the S&P 500. B, I bought an ETF that tracks the S&P 500.
The answer is B. You cannot buy an index. You buy a fund that follows it. We keep coming back to that.
Situation 5. What does company-specific risk mean? A. The risk that one company performs badly, affecting your investment. B. The risk that the whole market falls.
The answer is A. Company-specific risk is about one company, one bad event that affects you because you're concentrated there.
Situation 6. A colleague says, "I'm building a position in Microsoft." What does she mean? A. She is working at Microsoft. B. She is gradually buying Microsoft shares over time.
The answer is B. Building a position means buying more shares over time, slowly and intentionally.
How many did you get right? If you got all 6, excellent. You've been listening carefully.
If you got 4 or 5, that's still very strong. Go back and listen to any section that was unclear.
And if you got fewer, don't worry at all. That's exactly why podcasts exist. You can listen again. The vocabulary takes time to absorb.
Now, one challenge before we close. Say this sentence out loud right now. I prefer index funds because they're diversified and have a low expense ratio. Say it. Don't be shy. Speaking out loud is how it becomes natural.
Wow, we really covered a lot today.
We did. Let's do a quick recap of everything.
First, we learned what a stock actually is. Ownership in one company, a claim on profits, voting rights, and the risk that comes with being concentrated in one place. Company-specific risk.
Second, we learned what an index is. A group of companies used to measure part of the market. The S&P 500, the Nasdaq, the Dow, the Russell 2000, and, importantly, something you cannot buy directly.
Third, we learned how you actually buy the market through ETFs and mutual funds, baskets of companies, diversified, with expense ratios to understand, and the philosophy behind owning the index instead of picking winners.
And fourth, we learned about sectors, how the market is organized by industry, technology, energy, healthcare, financials, industrials, consumer discretionary, and how to talk about them professionally.
Before we go, we just want to say thank you. Truly.
We love seeing your English improve through topics that actually matter in your life. That means a lot to us.
The fact that you're here, learning not just English, but how to think and talk about money, that's something to feel proud of. You're doing something real for your future.
Keep going. Even a little practice each day makes a difference.
And in the comments, tell us this. After today, which type of investment sounds most interesting to you? A single stock, an ETF, or a mutual fund? Write your answer in English.
Next time, we're talking about dividends versus growth investing. What does it mean when a company pays you regularly, just for owning it? That's next.
Take care of yourselves.
We'll see you next time.
Bye, everyone.
Bye.